G'day Equity Mates, Bryce here, jumping in before we get stuck into this episode. What you're about to hear is the first episode of our newest show in the Equity Mates media stable. It is called Basis Points. Now, Basis Points is aimed at advisors but available for all, and it will feature conversations with Australia's top financial advisors and fund managers as we search for those small improvements that'll compound over time. Now, we know thousands of financial advisors listen to Equity Mates, but we wanted to create a resource specifically for you guys to tune into. And the best part, the majority of these episodes have been accredited by the FAAA for CPD points. So make sure you go and subscribe to the new feed. We will be releasing 6 episodes from the launch across the Equity Mates feed over the next 3 weeks. Some of the fascinating conversations with fund managers and financial advisors that will be relevant for all listening today. So we hope you enjoy it. Make sure you subscribe to our newsletter as well, and we'd love to hear your feedback.
Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Private credit, clean energy, cryptocurrencies, there's so many new asset classes emerging. Today, we're asking one of Australia's top financial advisors how he assesses these opportunities. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce with my co-host Ren, and today we're chatting to one of Australia's top-rated financial advisors about how he assesses investment opportunities. Ren, good to be with you.
Bryce, good to be with you. Good to be here for a new show. I'm excited for this one. Basis Points, all about finding those small improvements that can compound over time.
Yes. Joining us is Charlie Viola, founder of Viola Private Wealth, who is regularly rated as one of the top financial advisors in Australia.
Now, before we jump into today's episode, we'd like to say a huge thank you to our 3 launch partners supporting Basis Points and helping us keep all of our content free. Thank you to Orbis, to Milford Asset Management, and to SIBO.
Yes, couldn't be doing it without you guys. This episode has been accredited by the Financial Advice Association of Australia for CPD points. So after listening to the episode, go to the link in the show notes or the description below and you can complete a short quiz and get your certificate.
Now, in today's episode, we're going to talk about how Charlie got started in advice and then how he's made the move, set up his own shop at Viola Private Wealth. We're going to talk about portfolio construction and how they build portfolios for their high net wealth clients. But most exciting for us, we're going to talk about the emerging asset classes. You mentioned it at the top: private credit, clean energy, AI infrastructure, cryptocurrency. There's so many funds and fund managers on these emerging asset classes at the moment. We want to understand how Charlie and his team assess these opportunities and what we can use in our own processes when these opportunities come across our desks.
Cannot wait. It's going to be a cracker. Well, Charlie, welcome to Basis Points.
Thanks, gents. All new concept.
Yes.
Very excited to be here.
Yes.
Yeah, I am excited. I'm excited for this concept. All new concept, same old hosts. But yeah, thank you for joining us. So in today's conversation, we want to start with a bit about your journey, but in particular how the advisor market and how the job of an advisor has changed over that time. Then we want to talk about portfolio construction and then some of the asset classes that you can invest in within that. So a lot to cover. But Charlie, we want to start at the beginning of your journey. What got you interested in advice as a career and how did you get started?
I've been doing this for ages, hey, even though I look this young. So I'm now like a 25-year veteran, as someone called me the other day. I'd probably one of that cohort that actually fell into it, if I'm really honest, because I started life as a bank teller, was probably reasonably good at talking to people, so ended up in the bank with some sort of deposit-taking roles, and then the next kind of natural evolution was to go into kind of the junior advice roles. From there, started to enjoy having conversations with clients, and it was really more about the conversations with the clients than it was about investing. I think I came to love investing later as a result of seeing the impact that I could have on people's lives, as opposed to the other way around where I was this investment nuffy and was, 11 and trying to buy ETFs, and then decided to become an advisor as a result, sort of thing.
So you've built an incredible advice business at Pitcher Partners. What are some of the lessons that stay with you from the journey of attracting new clients and growing assets under management?
I think there are a few. I think the big one for me, and where the business really started to sort of take off and go well, was when I became unequivocal as to what I was. There's a real lesson here for advisors. You are what you say you are. The minute that I started to tell the market that, hey, I'm an investment guy who looks after people with kind of 3-4 plus million of investable monies, that's the type of work that actually started to come to me. It was very much about making sure I told the market what my value add was, what I wanted, the type of client that I think I could add value to. And then that's what started to actually come to me. And then from there, the next bit really was making sure that I resourced for growth. So what happens in most advice businesses, especially ones that start from scratch, is that advisors try and be kind of everything. They try and wear the compliance hat, the investment hat. Everybody ends up being a bit Dennis Denuto in their experience. What we learned pretty quickly was that, the minute we brought in a really good governance guy and, really good portfolio admin people and really good administration people, the time that we had to go and actually spend on finding great investments and looking after the clients just meant that we could just take on so much more growth.
Yeah.
So I encourage every advisor in every advice business is over apex on your investment in your resources, and you will absolutely see the benefit of it over a period of time.
In that time, your story starts at a bank and becoming an advisor at a bank. Not too many young advisors listening to this would have a similar story, because the advice landscape has just changed completely over that 25-year period. What are some of the big changes that stand out for you, but probably for the young advisor audiences listening today? What are some of those changes that you're still seeing today playing out that they should really be aware of?
When I first became an advisor, it was all about product. It was all about trying to sell managed funds. It was all about effectively being a distribution for product. And I think a lot of that came from that, remember, lots of the early advisors in our world were people from the insurance industry. So they were very adept to selling, and it was all about generating a commission, and it was all about having as many of these people who were stuck into a product that would pay you a commission, right? The major shift has become about advice. It's become about meeting people's needs. And that's obviously, very positive, and it was absolutely needed to occur. The other major shift clearly has been the significant move in governance and education standards. So post the Hayne Royal Commission, we had this massive change to our businesses in terms of what we needed to do from a compliance and governance perspective, but especially the educational requirements. Remembering that the advice industry's gone from having like 25,000 advisors down to 13,000 or whatever it is now. And while some of those changes were actually really quite painful and pretty annoying, so even a guy with like 20 years experience like me had to go back and do a couple of bridging courses to make sure that I was qualified. So I was less qualified in the regulator's eyes than somebody who had done 2 years of experience, right? And that was annoying.
Yeah, imagine.
And it's like turning the QE2 around, right? It takes a long time for this big ship to turn around. What you've now got is better people who are more well-educated, who aren't coming in to be salespeople, who are coming in with, these kind of professional service standards. And rather than kind of this being the kind of occupation that you kind of got to because you couldn't do anything else, we're now competing for the talent with accountants, lawyers, doctors, etc., because people really see the value in what they bring, what they're able to do. And these are great businesses to work in and great businesses to own, because you've got more and more people who need the service and you've got less and less people doing it, right? So just the simple supply and demand dynamics means these are great businesses to work in and great businesses to own. And, the thing that had to happen was those standards had, the bar had to rise, and it did. And we're now absolutely seeing the benefit, the benefit of it.
Was 25,000 advisors enough? Like, what's the equilibrium, do you think?
We went to an industry thing only a couple of weeks ago and it was about high net wealth individuals and the high net wealth market, right? Which every advisor will tell you they want to work in the high net wealth market because simple maths tells you that the more money the client's got, the more revenue you're going to produce. Yeah. The stat that we saw was that high net wealth and ultra high net wealth individuals. So the way they described that was a high net wealth individual with someone with sort of $2 to $5 million of investable monies, and somebody with like 5 to 100 was an ultra high net wealth individual. There was a study done that in those two brackets, there were 440,000 people who are effectively unadvised.
Wow.
In the ultra high net wealth and high net wealth market, there are only about 2,000 or 2,500 advisors. So if you think about the addressable market that we actually have available to us, it's like people will go, oh, who do you compete with? At Viola Private Wealth, who do you compete with? Coda, Crestone, Escala, UBS. It's like no one. Like the reality is there are enough clients for all of us. So really the job should be let's all go. Just do a better job. Let's all just do the right thing by the client, and then we will all benefit from this and we'll provide a really good service. The problem we all have, and the problem that the industry has, is that because of all the governance stuff that's gone on, the cost of advice has gone up fairly significantly. So where the cost of advice previously was offset somewhat by product providers, so AMP paying big commissions to advisors, with a bunch of that gone, with a bunch of the vertical integration gone and the sort of the conflicts being removed, now everybody just wants to service that bit of the market or the top bit of the market, and nobody wants to service, because if there's 400,000 in the top bit of the market, then obviously there is 6 million in the bottom part of the market that nobody wants to service unless you come up with a really efficient way of doing it. So yeah, like I said, these are great careers to have. They're great businesses to own. And, those of us with good systems, good processes, great infrastructure are really going to benefit from that over time, because we're not really competing with anybody, because the addressable market's massive.
Yeah.
Have you seen anyone in that lower half with incredible efficiencies in delivering that?
Yeah, there are very likely really good businesses out there that use lots of, I guess, tech, like lots of fintech. And, the other major change in our world is that fintech and regtech has just come through the roof. There are so many really smart people putting that stuff together. When I first effectively started the business at Moore Stephens, which became Pitcher Partners, I had no idea that we were doing something that was maybe going to be what they did in the future, where we held assets non-custodial and we did private assets, etc. We did it because we thought that it was the best way to service a client. We wanted to show them different types of investments and we wanted genuine diversity. So we were really the first ones to do, off-platform, not managed funds. Now, the technology just allows every advisor to do that. So the really good businesses are really invested in the tech and, pre-mixing of portfolios and the use of SMAs and the use of technology to be able to produce great portals for clients to look at, etc. But those businesses have to be really, really efficient, because if your average client size is, the average value of what someone's got in super, 3 or 4 or 500 grand, which means that the average fee is 3 or 4 or 5 grand per client, then you have to have a lot of those clients to be able to make it really commercially viable.
Now, Charlie, you mentioned Viola Private Wealth. That's been a big step for you, and I imagine a lot of advisors working at different firms dream of one day stepping out and going out on their own. So what's that process been like? What motivated you to do it? And maybe what do you want to try and do differently to other parts of the industry?
Yeah, so we did a management buyout of the wealth business in at Pitcher Partners in Sydney. So we were, lucky enough that we acquired the existing entity. So we bought all the systems, the process, the infrastructure, and all the things that we've been investing in over the last kind of 20 years. So it's a little bit like same shop, different sign. So you don't realise when you change the sign how many stickers you've got to change along the way. So, the absolute motivation to do this was that we wanted to build a brand that became synonymous synonymous with high net wealth private clients or high net wealth private wealth in the marketplace. Picture brand is great and very strong, but in lots of ways it means accounting. We wanted to build something that really meant wealth. And, so when somebody sells their business and ends up with a bag of 20, or, somebody wakes up and thinks, oh, who do I go and see? I want them to kind of think about Viola Private Wealth. The main motivation, though, for us, I think, was about building a model that we can bring the best advisors. We've got great systems, great infrastructure, and really we've got a business from a platform point of view that we can handle on our existing infrastructure, 10, 15, 20 advisors. What we wanted to do was build a model that really incentivizes advisors to come and grow the value of their asset base, which is their clients, in an environment that allows them to get value out of that over a long period of time. So there are really good advisors out there with great client bases. Lots of them actually don't have anything to show for that client base when they get to the end of their career. They just got to basically hand it to somebody else. So we want people to come along and have genuine ownership in that, and then just be incentivized to grow their businesses sort of over time. So the other thing for us is we just want to make sure that everything that we do kind of day in, day out is really kind of client-centric. This notion where, advisors are often seen to just be really transferring the client's wealth to themselves. We just want to make sure that everything that we do from a systems point of view, a portal, a viewing, a investment selection, etc., is all about putting the client at the center of what we do. We also want to remain somewhat unconstrained. So the bigger any advice business gets, and certainly the ones linked to big investment banks, will end up being constrained by something, right? They'll be constrained by what the house thinks. They'll be constrained by trying to create sort of governance and compliance to have the place not blow up. We want to be an investment business, which is about meeting the needs of the client in the context of what the client actually wants. So we want to remain kind of unequivocally investment people and investment managers for families. So if we think about the upside potential associated with any private wealth business in the marketplace, it's huge. And, we want to build a model and grow a brand that allows us to take advantage of that.
Well, Charlie, speaking of being investment people, let's turn to unpacking portfolio construction. At Viola Private Wealth, what are your foundational principles when it comes to portfolio construction?
It's pretty simple for us, and I've probably been quoted as saying this 1,000 times. For us, it's diversity and asset quality. The key screen for anything that we do is this going to blow up the client's money? Right. So that's absolutely what we don't want to do. Right. So we want to send the client's money out. We want it to come back with friends. So from our perspective, it is always going to be about asset allocation, diversity. But most important, the biggest screen is that asset quality thing. We want to generate revenue through the cycle, but we want to make sure that we're investing in good things. So,
Charlie, how do you take those, foundational principles that sort of apply across the business and then tailor portfolio construction and a bespoke portfolio for each individual client based on their goals and their needs?
Yeah. So we are big ones in terms of building those portfolios around the context of the client needs. So we spend a fair bit of time early on with the clients understanding where they're at, what they're doing, what they're looking for. One of the main questions we ask every client is, what age would you like for work to be optional? And what level of passive income do you need for work to be optional, right? Because most people don't retire these days, because if you retire too young, you tend to get bored and go mad, right? So you end up wanting to do other things. But not everybody wants to be chained to their desk. And, some people want to go off and do charity or board roles, or, go and be a bohemian or whatever it is that they want to kind of do in the sort of second part of their life. So we absolutely want to put portfolios together in the context of what they're trying to achieve. But like everybody, when we say that, it's also about coming up with the right investment principles. And I need to be careful about how I say this because it could be misconstrued. But remembering that there is still the right way to invest. There is still good investments that if they're good for you, they're going to be good for somebody else. It is just the mix of those assets which changes in terms of how much you have for any particular investor. The reality is that lots of portfolios over time will end up looking reasonably similar because we've done the due diligence. We've reviewed the asset. We like the way that revenue gets paid. We like that company or that portfolio of companies because it's delivering a certain thing, which means that generally speaking, it's going to be good for a bigger cohort of people. So when we put portfolios together for people, it's about diversity and it's about asset quality, but it's also about making sure the mix of the assets is in the context of what they're trying to achieve. But generally what makes up that mix is going to be a bunch of similar things because we know it, we like it, we trust it, and we believe it's going to produce an outcome for them, if that makes sense. So putting together bespoke portfolios doesn't mean that if we've got 150 clients, we have 150 like portfolios that are all completely different. They absolutely won't be, right?
Yeah.
There will be a cross-section of great similarity because that's what we believe in and that's what we trust and that's what we think is going to produce good outcomes for clients. Does that make sense?
It does.
Absolutely.
And you could invert the thinking to explain it and you could say no client's individual needs or, bespoke goals or anything would ever warrant them being put in a bad investment. Bad investments would never be in any portfolio. Yeah.
But also everybody's needs are different, right? But everybody's needs are actually pretty well the same.
Yeah, so, financial security.
Everybody's needs
Retire
are actually
early.
the same. It's I've met hundreds of people over a really long career, and I guarantee you, when I ask the question, what age would you like work to be optional? I don't know, between 50 and 65 is always going to be the answer, right? And for some people it's 55 and some people it's 57. And what level of passive income do you need to make work optional? Well, I'd like to kind of replicate what I'm earning now, right? So the answers are pretty much going to be the same, which means the production of the outcome in terms of, okay, well, if you want to earn 250 grand a year as passive income in retirement, then we need pretty close to 5 mil of investable assets. It's no more complex than that. And then when we get to that point, okay, we have $5 or $6 million of investable monies. How do we generate the 250 or 300 grand a year of income you need? Well, it's going to be the same for the guy that's got 10 or 15 or 20 who is going to want a bigger number.
Yeah,
you know what I mean?
I was going to ask that. Someone sells their business, comes to you with 10 or 20. The question of when do you want to stop working has been answered.
Yep.
Is it then just how much passive income do you want and how can we make this 40 or 50?
Correct. Yep. So how do we achieve?
Nice.
So that's exactly what it is. So I actually got a client who listened to me on your show who did exactly that. Right. He sold a NDIS services business. Best bloke I've ever met, right? The nicest guy. And he sold that business for 15 or 20. And he said, I want to make sure that I can continue to do all the things that I was doing when I was working really hard now that I've got more time, but I also want to leave a bit of a legacy to my kids. I worked really hard for this business. I want to be a good human being and I want to leave a legacy to my kids. How do we do that? So we just build the portfolios around making sure it's delivering the cash into the bank account so he can buy bread and milk and rice and race cars and whatever else.
All the essentials.
The essentials,
But then make sure that we are also protecting the buying power of the money over a period of time. So we do need capital growth. We need earnings growth within the portfolio. It's honestly not that complex. Nothing that we do is rocket science. It's about educating the client that it's not rocket science. It's also about educating the client that we will go through periods of volatility and changes. But the thing that we can almost always bank on is if we get the portfolio mix right, cash will always flow into the bank account. And that's the bit we have to do and we have to do really well.
Yeah, love it. So once you've set that individual portfolio for the client with their individual goals and needs in mind, what's your ongoing process of reviewing it with the client? How are you, balancing the clients' perhaps desire to, change things
cars.
around, buy race cars, give you a call and ask you about a stock they heard with the long-term time horizons that we all know that are so important when it comes to investing.
Yeah, I think there's a few points to be made here. One, when somebody brings us a bag of, 15 or 20 or 50 mil or whatever it is, we're pretty slow to deploy. So generally speaking, for brand new money that we take on, it'll often take us 12, 18, 24 months to fully deploy the money.
Wow.
So we will generally deploy the lower risk ends of the portfolio pretty quickly to make sure that revenue is being produced. And then we'll kind of build up the growth end of the portfolio depending upon markets, because really we want to invest into opportunity and weakness. We don't really believe that we just tip it all in on day one and hope for the best. We're going to produce the best outcomes. We just won't. Like historically, you need to wait for those opportunities and you need to wait for weakness. When we are fully deployed then we'll use the defensive ends of the portfolio as our liquidity. So we have a process because we do a fair bit of the private asset stuff in our portfolios. We're talking to the clients reasonably regularly. We're talking to them about new opportunities that are coming along, where it fits. But also when those things start to mature or those things start to come back, we have almost this kind of cascading discussion that goes with clients to say, we invested in these types of assets or this asset class. The private equity fund is now giving the money back, or the property syndicate has now sold the asset and they're giving the capital back, or the private debt that we invested in has now been repaid, or whatever it is. So we're having conversations all the way along, and we keep sort of building that back into the context of, what does your asset allocation look like? What are you trying to achieve? Are we still generating the revenue that you need? So we're having conversations reasonably regularly. The way that we do it, and not everybody will do it this way, is that we do a formal 30 June and 31 December investment report, which is really just kind of a wrap up of what's gone on over the last sort of 6 and 12 months, what's done well, what's done poorly, what your asset allocation looks like, what revenue got produced, what the goal was, are we achieving what we thought we would? And then we hold ourselves accountable to make sure that we benchmark the returns versus, the kind of major indices. Then over time, what we encourage all clients to do is, if they've got thoughts, questions, and especially ideas, and it happens all the time, right? We want them to come and bring those to us, because what happens all the time, especially in the high net wealth market, is old mate who lives in Mossman, his neighbour will lean over the fence and kind of and go, "Hey mate, I used to be an investment banker and now I'm a private credit manager," because that's what they go and do. And I've tipped all my money into this, and I've sort of run out of other friends and family. You've got a nice car and a big house, and you live in a suburb same as me. So you must have some money. Would you like to put some money into it? And that happens all the time, right? So then they'll bring that to us, and we'll do a review. If we like it, we'll contact the boutique manager and do the proper due diligence. And we do about 100 hours of due diligence on any new asset before we tip client monies into it. And we have a screening process. And there are some things that don't get past the first screen, and we just throw them away, right? If we like it, then we'll go back to the client. Yeah, we like it. And it either fits in your portfolio or it doesn't. But, we might participate for this guy with other clients that it does fit. And then there are some people who bring stuff and go, "Oh, my mate's invested in this and I really want to invest in it." And we'll do 5 minutes of due diligence and go, "It's garbage." And they go, "I don't care. I'd rather lose 50 grand than watch them make $1 million bucks." And
just like a little fund for that sort of stuff.
Regret minimization.
Yeah.
And then when we produce the returns at the end of the period, we do the total, and then we carve the bits out.
That was on you. Yeah, that was on you.
That was your fault. Yeah.
The told you so measure.
It is an education process, and it is their money. So, they come to us for counsel, but at the end of the day, it is their money. And it is also about having, because these are very real relationships, right? You get to know your clients very well over a period of time. So, I feel very able and very open to say to clients, that is rubbish. We just don't want that in the portfolio, and here are the reasons why. If they want it in there, it's their money.
Yeah, yeah. Speaking of education, Charlie, do you have any tips for advisors on how to best educate clients on the investment principles that you speak of and around portfolio construction? And how important is it to educate the client as well?
Yeah, so I think the most important thing that we will ever do is educate the client on how you're investing their money and how you're building up the portfolio. So, the people in my office will laugh because, I'm like a frustrated school teacher. The minute the client sits down, I get up and start writing on a whiteboard, and I've got like a series of boxes and charts and triangles and stuff that I draw to try and educate the client in the simplest way possible. Teaching the client about asset allocation, about how different assets perform, about how where return comes from the various different types of investments becomes really important, because in periods of volatility or uncertainty or whatever, you want the client to go, yes, actually we spoke about that, and it's okay because cash is still flowing into the bank account. The only client that will ever complain is the one that you haven't educated. So in reality, again, these are very real relationships. You are trying to make sure that you give the client the best mathematical comfort you can, that they're going to be okay forever, right? And the best way to give them absolute peace of mind is for them to know exactly what it is that you're doing and why you're doing it. So we spend a lot of time trying to educate the clients around that. And we've got a reasonable cohort of investment bankers and, genuinely sophisticated clients. We still do a lot of work on portfolio construction, and because it would be very easy for a client to come to us over the last 12 or 18 months and go, well, why didn't we just put everything in US tech? And we would have produced 35% returns. Well, we absolutely could have done that, and it would have blown the doors off. But it breaks every investment principle of diversity and asset quality that goes. And remember that doesn't matter how old you are, it doesn't matter how old the client is, we are all investing for a 50 or 60 year time horizon. So we have to consider it over that time frame.
Just fast forward the 18 months before that, and that's a big reason why you wouldn't go all in on US tech.
Correct. So
just to get really practical there, so you said you'll meet face to face with a client and you'll stand up and get on the whiteboard and start writing. Have you found that is the most effective way? Like, are there any ways that you see maybe other advisors try and educate clients? Sending them books or trying to get them to listen to Equity Mates that it just isn't as effective.
What I find is especially busy people who are working, if you send them stuff they won't read it. If you send them, bunches of, kind of articles with jargon and all that sort of stuff, they won't take it in. Most people are visual learners, right? When I went and did the Harvard Business School study, which was their leading professional service firms, there was a whole case study on how like 83% of people are actually visual learners. If you get up and you draw a picture, it'll actually educate them far better than sending them an article that's, full of acronyms and jargon and, industry concepts and all that sort of stuff. My meetings with clients would seem to the client to be very conversational, but they're actually really structured. They go through a process of, where are you today? How do we structure this the most efficiently? How do we get all the right money into all the right buckets? And then how are we investing the money in the buckets? And it's no more complex than that. Before the meeting, I get an understanding of what they've got. Then I get up and I draw a picture on the board, which is 4 boxes. There are only 4 tax structures in Australia, right? You can only invest 4 ways. You can hold assets in your personal name, you can hold assets in a trust, in a company, or in super. They're the only 4 tax structures that we actually have available to us. So I just draw those 4 boxes, put the tax rate underneath and go, right, if you invest in your personal name, your tax rate is going to be between 0 and 49 cents in the dollar. Invest in a company for investment purposes, tax rate's going to be 30. Invest via a trust, well, trust doesn't pay tax, so it's going to be between 0 and 30, because once you've distributed to an individual over the 30% tax rate, we'll distribute to a company, right? And then super, and we draw a line and we go, super's on the other side of the line because it's going to be the most tax effective, but there's some encumbrances. And then we start to go, right, in your current situation, this is the boxes. Here's where we want the money to go over a period of time. And now that we've got all the right money in all the right buckets, we will work on how to best produce the best returns within each of those buckets for you. And it's no more complex than that.
Nice.
You say it's no more complex, but I need you in front of a whiteboard drawing that out. Well, Charlie, we're going to take a quick break here, but then on the other side, we want to, drill down on some asset classes and get your thoughts on them, including some emerging asset classes. You mentioned private credit. We'll get your thoughts on that in a minute, but before then, we'll take a quick break. Welcome back to Basis Points. We're talking with Charlie Viola of Viola Private Wealth. Charlie, we've touched on your journey in the world of advice, 25-year veteran, as you pointed out. And we've talked about some of those principles of portfolio construction and then how you apply it for individual clients. But we want to talk about emerging asset classes because, as you mentioned, you're primarily an investment guy. That's what you're known for in the industry. And I think I couldn't imagine how many opportunities come across your desk. Probably every boutique fund manager in Australia is sending you their pitch decks and trying to get you to assess their fund or an asset class that they're investing in. So what's your process as new asset classes emerge, as new funds come to market? How are you assessing them, both just like standalone, as are these good, and then also are they suitable for clients?
Yeah. And absolutely, we are investment guys. It is really important to understand that, part of that first conversation with the client is we want to make sure that the right money goes into the right buckets, and then we turn into the investment people once the right money is in the right buckets. Secondly, you're right. We see a lot of stuff, right? So when we did the launch of Viola Private Wealth, and we talked a lot about the fact that we've got high net wealth clients, and we probably have an allocation of sort of between 25 and 40% in private assets. You can only imagine how many of these. There would have been over 1,000 people going, "Hey, I know you're really busy with the launch, but do you mind having a look at our fund?"
Yeah.
So I think it's one of those things, right? People hear alternates, or they think emerging asset classes, or they think alternatives, and they think you're going to tip them into a Guatemalan coal mine or something, when in reality you're not, right? They're just all very normal assets that are wrapped up in a different way, and often in an illiquid way, where the client or the investor gets a bit of a liquidity premium attached to what it is that they're actually investing in. The first thing that we do when we see something new is we work out whether or not at that point in time we've actually got capacity to participate or review it. So there's only so many things that you can show your clients at any given time. So if we've just gone and participated in a raise and stuck money into what we think is a really good private equity fund in the buyout space, because we really like it, we like the manager, we've done the due diligence, and we've just gone out and we've raised and stuck $30 million of client monies in there, or $50 million of client monies in there, and another one comes to us, then it's going to be very hard for us to then go back to the clients and go, "Hey, I know I told you that was really good, but hey, this is really good too."
Yeah.
So often we will do 5 minutes of due diligence and go, "Actually, we really like it, but we're probably going to have to participate in your next vintage rather than this one." And, we just participated in Pep's most recent raise, and I know that you had Cameron on Equity Mates a little while ago. We really like their process, right? We really like where they are. And we have a few different sleeves for private equity in terms of like VC, emerging, buyout, etc. And we really like it for that sleeve. So we go through that process with any manager that we talk about. Do we have capacity? Does it fit in the sleeve? And do we have time to do it now, given what else we're sort of talking to the clients about? Once we get through the point where we know we've actually got some capacity and we've probably got clients who will like it, we will start to delve deeper into the manager themselves. Because with all private assets, you are very much backing the jockey. Yeah. So you are relying on the manager having good processes and good systems and doing a good job. So from a historical point of view, we want to know that the manager has done a good job, has been able to work through when there's issues within their portfolios, especially in the private debt space. If debt ever has to step into the shoes of equity, we want to know they've got an ability to get us our clients' money back. We also want to know, especially for boutique managers, that they've got skin in the game. So we want to know that balance sheet is also investing in this, which is often why we've liked boutique managers that come off the back of family offices, because often those boutique managers off the back of family offices really has been investing the family office money for a whole lot of time, and now they're bringing some of it to the private market. We want to know that the balance sheet is a co-investor in that, because we want to know that the managers are being held accountable by the people giving them the money, kind of thing. So, and then we have then depending upon the asset class, we will have some screens in terms of whether or not we'll look further. So we have probably gone away in terms of both private debt and property equity from single asset lending or single asset, just because we want to be more diversified. So it's kind of one of our screens now. We're moving more to using a sort of a fund approach. And we will have a number of screens in the private debt stuff or the private credit, LVR, sponsor strength, etc., that will tick some boxes before we'll actually get to the underlying detail.
What percentage of funds do you actually think pass your test, like get to this is good to go?
Oh, like 5.
Nice.
Like 5 or 6. But what that also means, though, is that you build up a knowledge base over time of the people that you really want to work with, right? Yeah. Because you're busy and because you're trying to allocate money at the right time into the right places, when you start to build up genuine trust and belief in a manager or a group of guys that are doing a really good job, you will tend to if they bring a new vintage out or they bring a new fund out or they bring a new series out or whatever it is, you will tend to sort of, if you're sat with two options, you will tend to go to them because you know them, you like them, you trust them, they've given your clients money back before. You've got an ability to get directly to the right people when there's issues or if there's discussions that need to be had. Yeah. So you sort of build up over time this kind of knowledge base of who you're dealing with, who's looking after your client monies. We take very seriously and we're acutely aware we're dealing with people's life savings, right? So, for us, that kind of first principle, well, if we invest in this, is it going to blow up the client's money? Like we have to kind of use that as our kind of almost starting point from a diligence point of view when we're talking to a manager. And part of that is, well, how long have they done this for? And have they in fact done it for us? And then even when we're educating the clients in terms of what we're investing with, you go, hey, you might remember we invested with these guys on this project or in this fund or previously, and they did a really good job. Because you aren't really trusting the guys that you're giving your clients money to.
So it sounds like at Viola Private Wealth, a lot of your process is in-house. How much do you use like external aids for that? Like the fund rating agencies or asset consultants, or do you have a view on how they can play a role in the process?
Yeah, we do a lot of it in-house, and that's really just a legacy thing. So when we started sort of doing this back in, sort of 2003 or 2004, nobody was doing private assets. So really we had to find our own way to do the due diligence, etc. So really we just kind of built out our own kind of in-house team in terms of producing the due diligence and doing the reviews and what have you. In terms of widely held managed funds, we'll still look at the ratings and, be comfortable if the ratings houses have given them, 4 bananas or 3 pears or, 6 stars or, whatever the various rating houses kind of use. We don't use an asset consultant because we do it internally. That's another significant change in the sort of private wealth world, where there are lots of these really good kind of asset consultants who are now kind of bringing to market a service offering to smaller advisory practices who perhaps don't have the level of funds under management we do, and providing those services kind of on a theoretical, holistic basis to those groups around, they've done the due diligence on the best funds, the right asset allocation, the best premix, all that sort of stuff. And I sit on virtually every other panel ever in the industry at the moment. And I'm meeting more and more of these guys, and, they're creating really good businesses around helping these advice businesses kind of put these portfolios together.
So Charlie, we're interested in understanding how you assess like the sustainability of an emerging asset class, if it's, a fad or if there is actually long-term value there, but we want to do it through the lens of a game where we're going to throw some asset classes at you and get your view on them. So we'll start with private credit. What are your thoughts?
I think sometimes people think that this is all new stuff. People have been lending money to other people for thousands of years, right? Like, why is it suddenly new that people are lending money?
Who's lending the money?
Yeah. So I don't think it's a fad. I think though that what happens is that when people think that it's easy and there's more and more and more of it, the risks go up. So I don't think it's a fad, but we're really mindful of the risks. I think 5 or 6 years ago, the return that you were getting versus the risk you were taking was probably asymmetric. You were generating really good returns for pretty low risk because of property prices and whatever else. I think that balance has changed a little bit. So we're really mindful, especially in that kind of asset-backed or property-backed stuff. We don't do construction. We want LVRs below 60%. We want good sponsor strength, etc. So not a fad. It'll continue. All the there are more and more non-bank lenders than ever before. Just pick your partners well, because, not a day goes by that somebody from somewhere hasn't rung me and go, oh, I'm lending money to someone to do this. We'll pay a 14% coupon and I was like, no, go away. Like, you just got no balance, you got no balance sheet, no ability to, you really want to work with the non-bank lenders who have got an ability that if something goes wrong, they can either step into the shoes of the equity, or they've actually got other products within their suite where they can sell that loan to the other higher risk stuff, so that our clients who are in the possibly the lower risk stuff are actually always whole.
Yeah. Okay. Oh, that's interesting. How about AI infrastructure and data centers?
Yeah. So, I think there's still huge momentum and growth there. I mean, obviously all of this data has to be stored somewhere. So, we're still a believer. We're still an investor. It's like anything. There's going to be a whole bunch of ancillary businesses and ancillary things that kind of really benefit from those. So again, absolutely not a fad in our view. And I think that, while ever we continue to have more and more kind of AI, we're going to need more data centers, and there's going to be more need for renewable energy producing the power to, for the great big air conditioners that these things need to cool the stations, etc. So, and I think in some ways it almost creates new industry all by itself, you know what I mean? So, and it's just a matter of making sure we're picking the right managers who are in the right place to invest in those things.
Well, speaking of energy, what about clean energy?
I probably have started to change my view on that. Once upon a time, I would literally say, I don't care, and then get a whole bunch of hate mail and be told that I'm a climate change denier and stuff. But now I think there's a real use case for the unused renewable energy stuff. Obviously with renewable energy, if you don't use it, you lose it. There is a real case now where the unused stuff can be stored and then utilized for these really power hungry data centers and these kind of operations that need heaps of electricity, right? So there is an opportunity now for a lot of that infrastructure spend that was being kind of spent and then lost because they just couldn't use it all to now be kind of channeled to benefit these other growth kind of areas and these businesses which are absolutely going to need the power.
Cryptocurrency, how do you assess if it's a fad or if it's long term?
I don't know if I want to answer this. I got on stage the other day at one of these conferences and said, and he said he's 25-year veteran, race car driver and loves Bitcoin. And it's like, what?
Where'd you get that
I said
from?
I love Bitcoin. So don't know whether it's you bloke saying that or look, I think some of the thinking has really rationalized in terms of sort of cryptocurrency. I think once upon a time, we kind of all talked about all the various different coins and the different kind of blockchain and all that sort of stuff. And I think it probably has just now rationalized to a couple of the major ones in Bitcoin. What has happened though, and with the kind of the benefit of hindsight, is, to be honest, they pretty well just correlate to financial markets. Mm-hmm. So obviously Bitcoin do really well over the last kind of 12 or 18 months as financial markets have done really well. So whether it's a hedge, I'm not particularly sure. We don't put Bitcoin into client portfolios unless they specifically ask for it. Like we don't have a cryptocurrency kind of allocation in portfolios. But if clients ask for it, we will just stick with Bitcoin because it's also probably correlates to the other major coins and the other blockchain, the other blockchain assets. So I don't have a particularly strong view. We took a little bit of a picks and shovels approach where we thought the miners would do well, and some of those have done well. But again, they're just correlated to the Bitcoin price, which has tended to be correlated to markets generally anyway. So it probably fails a little bit, the asset quality test when we're thinking about diversity and asset quality. But if people want it because they think, it's going to go from 70,000 US, whatever it is now, to $1 million, like they keep telling us, then they want a piece of that, then we'll do it. But it's not part of a normal portfolio.
It's part of that regret minimization.
Exactly. That's exactly what it is.
You're going pretty well at the moment. Now, Charlie, we want to close with a couple of questions relating back to your experience in the advice industry for those young advisors that are listening. What's one piece of conventional wisdom from the advice industry that you think is just incorrect?
I think the big one for me, and it goes to that kind of cost of advice thing, you got to marry the client before you even start dating. And what I mean by that is because of the governance requirements and because of the regulatory overlay, there is almost this requirement where you've got to get married to the client. You've got to know everything about them. You've got to get every piece of data. You've got to get when really they might just be coming to you to solve a very small issue. We have to be okay for advice to be separable, where we can just deal with the issue at hand at that point in time to keep that cost of advice down. Otherwise, people just won't go and get advice. And remember, there's that big cohort of people that absolutely need advice. The other I think for me is nothing that we do is rocket science. So simplify it for the client so that they understand exactly what it is that you're trying to achieve for them.
Yeah, I love that. And then on the flip side, Charlie, if there was one piece of advice or information that you wish every young advisor learnt early in their career, what would it be?
I think there's probably a few things. First one is do the right thing by the client and the rest will follow. So these are long-term relationships. You will generate revenue from that client over a really long period of time if you do all the right things and make sure that you're doing what's in their best interest. I think the second one is be unequivocal about the value that you're adding. I think too often people will be scared to talk about fees and getting paid for what they're doing. Be unequivocal about your value and the value that you're adding to the client, to their life, and helping them sort of meet their goals. And then for people who are kind of in the second part or the next step of their career, like resource for growth, because you will really benefit from it. I know personally when I brought, the CEO of Viola Private Wealth, Sean, and the COO of Viola Private Wealth, which is Andrew Levi, they joined the picture business back in 2017. So it had already been running for 14 years. I doubled my client base in the next 5 years just by having those guys there, because I could concentrate on the bits that I like doing, which is investments and talking to clients, and do a whole lot less of the bits that I hated doing, which was governance and resourcing and data and systems and stuff they're really, really good at, right? Mm. So people running these advice businesses, like, go and get a really good office manager, a really good kind of, resourcing guy or data guy or, governance guy, and your business will fly as a result, because you'll have so much time and energy to do the stuff that we're good at, which is facing the client.
Well, Charlie, that brings us to the end of our first episode of Basis Points. Thank you so much for coming on. If anyone listening wants to speak with you or work for you, where can they go?
We have an awesome new website that was very expensively put together.
So please use it.
Yeah, violaprivatewealth.com.au. So all our details are there, but otherwise, I think if you Google me, I'm pretty easy to find these days.
All over it.
That's right. So,
well, Charlie, we really appreciate you jumping on. A lot of information there. So thank you for sharing it. And thanks for helping us kick off this new show.
Awesome. Thanks for having me.
Thanks, Charlie. And just a reminder before you go that this episode has been accredited by the Financial Advice Association of Australia for CPD points. So go to the link in the show notes to complete a short quiz and get your certificate.
And a final thank you to our sponsors for Basis Points who help make this show possible and help keep it free. Orbis, Milford Asset Management, and SIBO. We couldn't have done it without you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.